Your portfolio moves when three headlines hit: inflation from the CPI report, interest rates from the Federal Reserve, and the jobs report. Here's how they connect to your stocks and bonds, and what to do today. Quick payoff first. If core CPI runs hot, pressure often lands on rate-sensitive names like tech and real estate, and on longer-duration bonds. If CPI cools, growth stocks and longer duration get a tailwind. Think of it as a chain. Inflation pushes the Fed on rates, and markets react to that path. Inflation is a silent thief. It eats your purchasing power. CPI measures how fast everyday prices change. It hits you two ways. First, real returns shrink. If your portfolio is up 7%, while inflation is 4%, your real gain is about 3%. Second, companies pay more for inputs and wages. If they can't pass it on, margins tighten and prices can fall. Some areas like energy or certain commodities can hold up, but broad markets usually struggle when inflation runs hot. High inflation forces action from the central bank. Rates are the price of money. When the Fed raises rates, borrowing gets more expensive, spending cools, and inflation tends to ease. But your portfolio feels side effects. Stocks get hit from two sides. Higher debt costs squeeze profits, and safer yields look more attractive. So money rotates out of risk. Bonds move opposite to rates. When rates rise, existing bond prices drop because new bonds pay more. Housing slows as mortgage rates rise, which weighs on real estate plays. Sectors with long payoffs, like parts of tech and real estate, are the first to feel it. Now the wild card, the jobs report. Strong hiring and rising wages support spending and profits. That sounds bullish, but if the report is too hot, markets can fall. A very strong labor market can keep inflation sticky and push the Fed toward tighter policy. So the market reacts to what the data implies for rates, not to good or bad news on its face. So what should you do? First rule, don't panic on headlines. A lot is priced in before you even see the alert. Knee-jerk trades often buy high and sell low. Second rule, diversify on purpose. Don't let one theme define your risk. When rates rise, cash-like yields, short-duration bonds, and some commodities can steady the ride. Third rule, think in sectors. When rates climb, long-duration stories struggle. Parts of financials may benefit as net interest income improves. When rates fall, growth and longer duration get a tailwind. Fourth rule, if you own bonds, know your duration. Higher duration means bigger price swings when rates move. Shorter duration cushions the hit. Fifth rule, review, don't churn. Rebalance once or twice a year. Adjust when your goals or the rate backdrop change. No day trading needed. Here's a simple two-step plan. Step 1. Check this month's core CPI trend. If it's hotter than the recent trend, trim concentration in rate-sensitive bets. Don't let tech or real estate dominate your risk. Favor some shorter duration bonds. Keep a modest slice of inflation-resilient exposure if it fits your plan. If CPI is cooling, add to growth more comfortably and extend duration a bit, still within your risk limits. Step 2. Use the jobs report as confirmation. Hot jobs plus hot CPI raises odds of tighter policy. Stay cautious on duration and on names that depend on cheap money. Cooling jobs plus cooling CPI points to easier policy. That backdrop favors growth and longer duration. Nudge positions, don't flip the whole portfolio. Make it practical with 3 quick checks. 1. Write down your sector split. If more than a third is in rate-sensitive names, decide if that still fits your risk. 2. List your bond funds with their durations. If rates are rising and your duration is long, ask if that matches your timeline. 3. Pick one hedging tool that fits your plan. That could be a short duration fund, a ladder of bills, or a small commodity sleeve. Keep it simple and sized right. Watch how markets react after the release, not just the headline number. Sometimes CPI meets expectations, but price action still swings because positioning was off. If banks rally while growth fades, the market is leaning higher for longer. If long bonds jump and growth pops, the market is sniffing an easier path on rates. Keep your time horizon in view. If you need the money soon, avoid big rate bets. If you're long-term, your edge is staying invested and letting compounding work. Use the news to fine-tune risk, not to swing from one extreme to the other. Small, steady adjustments beat big emotional flips. Here's a clean monthly rhythm. On CPI day, check core CPI versus the recent 3 to 6 month trend and review your sector and duration mix. Make small tweaks if needed. On Jobs Friday, look at hiring and wages. If both are hot, keep your guard up on duration and high multiple growth. If both cool, you can relax that stance a bit. Then step away and let the plan work. If this helped, consider subscribing so you catch the next breakdown. Tell me in the comments which headline trips you up most: CPI, rates, or the jobs report. And I'll cover the top pick next with simple charts and clear steps.